Move in Gold was designed to make you feel right. What you're seeing is not just price action, it's liquidity, being hunted, traders being trapped, and institutions positioning for the next move. In this video, it'll break down gold using pure price action, smart money concepts, and liquidity theory just like an institutional trader would approach it. Let's start with the higher time frame, the 1-hour chart. This is where we understand the real story behind price. We can clearly see a shift from bullish structure into a bearish move. Price formed a strong high and then failed to continue higher. This sharp move down is your break of structure. This is where institutions started distributing positions. This entire zone above becomes a premium supply area. This is where sellers are still sitting. Notice these equal highs. This is buy-side liquidity. Retail traders place stops here and institutions target them. After grabbing liquidity, price aggressively moves down. This is displacement, not normal movement. Here price reacts strongly. This is a demand zone where buyers step in. But notice something important, the bounce is weak compared to the drop. That tells us momentum is still bearish. Now price is stuck in the middle between supply above and demand below. This creates liquidity on both sides, and that's exactly what institutions need before the next move. Retail traders are now confused, buying breakouts, selling breakouts, and getting trapped in the middle. Now let's move to the 15-minute time frame to understand what the market is doing right now. On the 15-minute chart, we get a clearer view of internal structure and short-term behavior. Here price sweeps the highs. This is a liquidity grab designed to trigger breakout buyers. Immediately after, we see rejection. That's your confirmation, institutions selling into that liquidity. Then comes the real move, a strong bearish push clearing liquidity below. Now price is consolidating again, building liquidity before the next move. These equal lows are sell-side liquidity. They will likely get targeted next. Short term, we see slight bullish structure, but it's weak and corrective. Momentum is slowing down, which usually precedes a strong expansion. Sell setup if price returns into 4,850 to 4,865 and shows rejection. This is a high probability short. Entry at 4,855, stop loss above 4,885, targeting 4,800 first and 4,760 as extended liquidity. The logic is simple: liquidity sweep, rejection, continuation. That's institutional selling. This setup offers more than 1:2 risk reward, making it a high quality trade. Now the buy setup if price drops into 4,780 to 4,795 and shows strong reaction, we look for longs. Entry at 4,790, stop below 4,760, targeting 4,830 first and 4,860 as extended upside. This is based on demand holding and short-term bullish continuation after liquidity grab. So we have two clear scenarios: sell from premium or buy from discount. Pro tip: never trade in the middle. The edge exists only at extremes where liquidity is. Always align your trades with higher time frame bias. That's where consistency comes from. And remember, most breakouts are traps. Wait for confirmation, not emotion. This is how institutions move the market, and now we know how to read it. If this breakdown added value, subscribe, and in the next video we'll go even deeper into execution models.